Hello, everyone, and welcome back to this week's Money and Market Squawk Call, where we go around the horn with our editors to give you their insights on the happenings in global financial markets for this week and beyond. Today is Tuesday. It's April 5th. I'm Mike Bernick, and joining me today are Larry Edelson, Kathy Lean, Mike Larson, Mandeep Rai, and David Dukevich. All right, good morning, everyone. Go ahead and get started with the call this morning. Well, we've got the first quarter of 2016 is now in the record books, and we saw a gain of just over 1% for the S&P 500, which a small gain like that kind of belies the roller coaster-like volatility we had all along, with the S&P actually starting out the first 10 or so trading days of the year was the worst start to any year since 1928, since the index started. But, of course, stocks found their footing around mid-February and rallied significantly off that low to now we're right within striking distance of new highs again. And in other asset classes, we saw commodities maybe stabilize a little bit here during the first quarter. Crude oil found its legs and rallied back a bit. And gold enjoyed a tremendous rally the first quarter of this year, up 16%, which is the best quarterly showing since 1986. I have to go way back for that. Larry Edelson, on that note, let's go straight to you. With the big rally we saw in the first quarter in gold, do you think this is the start of a new bull market, straight up from here?
I think it's the start of a new bull market, but straight up from here, no. We should be pulling back to the 1190, possibly as low as 1160 level, to pull back and to confirm that first leg up before we head any higher. So I'm bearish so far, despite the choppy action. We are leaning towards the downside. We've held major support at 1202. I expect that to crack in the next week or so and get under 1200. And then I'd be a very aggressive buyer for the next leg up in the precious metals and in the mining shares as well. You have to remember, bull markets don't go straight up. Those are parabolic moves that are actually more bearish than bullish. Bull markets are formed by stair-stepping higher. 2 steps forward, 1 step back, 2 steps forward, 1 step back. That's really what we want to see here for a healthy bull market. And technically and cyclically, everything's lined up for a decline. We failed to take out 1287, then we failed to take out the 1260 level. So we have a series of lower highs and lower lows in place, but the overall trend is down back to below 1200, and then I'd be a very, very serious buyer. Same with mining shares. Same general pattern is what I'm looking for there. As far as, the global markets go, I have no changes that I see on the horizon, nor changes that the markets have gone through. It's kind of been like watching paint dry. Lots of trading ranges, but pretty much go nowhere, meaningless trading ranges. We've seen a new short-term high in the euro. I think we're at a top in the euro now and a bottom in the dollar. I have an issue going out this morning, getting bearish the euro. I'm bullish the dollar here, bearish the euro here. I think oil is bottoming in here at the $36 level, give or take, for another run up to the 40, 42 level, and then we'll see what happens once we get up there. So on and so forth. I mean, the global economy is not doing well. We all know that, and nothing's changed. So I don't see any changes in the markets either from a technical, cyclical, or fundamental point of view, just eating up some time after the pretty wicked large moves we saw in many markets in the first quarter. It's normal to see some pause and refresh before we see another major trending move. And I think that's what we're in for the past few weeks, and it should be coming to a close soon, and we should start seeing some nice trending markets again.
All right, interesting. We'll keep an eye out for those moves. Thanks, Larry. Appreciate it. And let's see, Kathy Lean, let's go to you. Larry just mentioned some of the turbulence we've seen in currency markets, with the U.S. dollar near the low end of its range and the euro topping out. What's your take on the movements we've seen in currencies?
Well, we've been long dollars for quite some time, and I think it's finally beginning to work out. We've taken we've been very patient with our short sterling, British pounds, long U.S. dollar trades, our short Canadian dollar, and I think we're now beginning to see the combination of fear in the markets along with deteriorating economic data, and also we continue to believe that Brexit is going to be a very serious risk over the next 2 months. And I think that's really going to not only hurt European currencies, but more specifically hurt global risk appetite. And I think that's really what's been driving a lot of the movements. Now, the big story this morning, likely this week, is the Japanese yen. We're watching that very carefully. It rose to its highest level in 6 months. So dollar yen dropped to its lowest levels in 6 months, and it's in intervention territory. The first phase of intervention is verbal. The second phase is physical. We heard verbal intervention from the chief cabinet secretary, and I think that it won't be long before we see some actual physical intervention from the Japanese government. So we could be in a new phase. Now, the Bank of Japan has intervened kind of stealthily in the past 2 months. There hasn't been overt intervention as we've seen in past years, but we are at prices, we're near prices at a time when the Japanese economy is struggling where that can happen. So we are looking at selling the Japanese yen for an intervention trade, because Bank of Japan knows that Japanese exporters are hedged much closer to 115 than 110, and their pain threshold is not very high in light of this environment. Now, of course, the counter point to that is that risk aversion is definitely the factors that's driving the yen higher, but intervention can easily supersede that if it's strong enough.
Interesting. Okay, thanks, Kathy. Let's see, Mike Larson. Let's go to you. You just pointed out this morning that some of the moves we're seeing in German bond yields actually approaching the record lows they reached back in March 2015 or April 2015. Looks like we have a repeat of that level coming up here soon. You think that's maybe a risk-off move, a sign that deflation still has the upper hand?
Yeah. Good morning, everybody. In the first phase of this risk-on, central banks are going to save the world again rally from February 11th through about March 11th. It's basically a one-month run. All indicators were generally heading in the same direction. Stocks were up, crude was up, bond prices were down, yields were up. Risk spreads were coming in, and currencies were behaving as if there was risk on. That actually changed about 2 weeks ago, and the stock market's the only thing that's too dumb to notice. If you look at, that sort of divergence in the last 2 weeks, crude oil topped out, European bank stocks, which were at the center of all these concerns about credit and loan losses and deteriorating earnings power and so on. All those European bank stocks, Deutsche Bank's one obvious example, but you could go down the list, HSBC, UBS, Credit Suisse, and on and on and on. All those stocks topped out and started rolling over. The U.S. bank stocks never performed as well as the overall market. If you look at the XLF, that basically stalled out about 2 or 3 weeks ago and has gone nowhere, even as the S&Ps have continued to move up. Biotech's been an absolute disaster. I mean, you can look at something like the IBB if you want there, and then you might have seen the news overnight that Allergan and Pfizer, who were supposed to be in the biggest merger ever, $150 billion or something like that, the Treasury Department came out with all these new tax rules aimed at those inversions, U.S. companies moving their domicile overseas to save a bunch of tax money. So Allergan stock closed at $278 yesterday. It's trading at about $225 as we talk. So that's probably one of the biggest wipeouts in the history of the company. And it comes on top of all those, Valiant Pharmaceuticals problems with that company, where that has gone from $260 to $26 in the span of a few months. So behind the scenes, there's been a lot of stuff going on that the broad market, again, has been sort of too dumb to notice, but now it's paying attention. And I think that the German Bund deal issue, as you point out, is another thing. German Bunds, yields have been falling, prices have been rising. The ECB is going to succeed at reflating, the economy is in better shape. The entire rally that happened starting in mid-February is now gone, and German Bund yields are about 9 basis points this morning, which puts them dangerously close to zero. So again, if you pay attention to other markets like I do, they haven't been signaling as rosy a backdrop for stocks for the past couple of weeks. The first phase of the rally, they did. Everything sort of rallied, but then we started to see increasing divergences, in mid March. So that's been something that's kind of been a red flag for this rally. And now we'll have to see if stocks pay attention. Obviously, S&P is down about 15, 16 points now. We'll have to see if that gathers steam. As far as currencies, I've been long the yen and the Swiss franc as risk-off moves for many weeks now. The yen has been a fantastic long since basically early January when I put it on. We're right now testing in yen futures. We're testing the breakdown level from November 2014. So the yen's gained back everything that Abenomics managed to accomplish, and I put the word accomplish in quotes, since November 2014. I think, as some of the earlier people pointed out, we're at these kind of key levels where you may see intervention. There was a Reuters story floated that, the BOJ now may take more action at its April meeting to try and save the world again. But, it's getting to the ridiculous point here where if you have to try and save the world as a central banker every couple of weeks because the market's not listening to you, that pretty much shows the futility of the actions they're taking. So, in a particular case of the Bank of Japan, investors are now trading actively against the Bank of Japan and fighting it rather than cooperating, as can be seen by the fact that back in February, at the end of January, early February, when they made their moves to depreciate the yen, it lasted for all of 2 days, and then the yen took off. So, long story short, I think that there's some fundamentals missing behind this equity rally. Bonds haven't been cooperating, commodities haven't been cooperating, so somebody's going to be wrong. So either the bonds get into the game, commodities get into the game, or stocks realize, kind of like that Wile E. Coyote moment where he realizes he ran off the cliff already and there's nothing but air under his feet. We'll have to see if that's what happens to stocks. So that's my take.
Interesting. Well, the ECB will have its next chance to come to the market's rescue in just a couple of weeks, followed by the Fed a week later. So that'll be interesting to watch. Thanks, Mike. Appreciate it.
Thank you.
Let's see, Mandeep Rai, let's get your take on the markets as first quarter earnings season gets underway here.
Sure. Hey, good morning, Mike. Good morning, everybody. Excuse me. Yeah, so like you mentioned, we've had a pretty solid run up from the lows at 1810. What's interesting is I saw a piece by a smaller brokerage firm, MKM Sell-Side Partners, and they noted that right now we've gone about 10 months with the S&P 500 without breaking out to a new high, and that's the longest stretch we've seen without a breakout since 2009. And that's only happened, that kind of range-bound move has only happened 11 times in the last 50 years. And now 8 of those times we saw happen during a bear market, and 3 of those times we saw a breakout. And the last time we saw that breakout was 30 years ago. So, April and May, these 2 months are going to be crucial. And unless we get to a new high, the odds, at least from a historical perspective, are going to be in favor of a move down. And we still could be in a bear market. It's too early to say that we're not. And I'm listening carefully to what Boris and Kathy were saying as well about the Brexit, because as I'm looking through the data and the economic reports and sentiment reports, I'm wondering what could be the potential catalyst, because this market seems to be shrugging off what's going on in terms of earnings, in terms of slower economic growth, and wild gyrations in currencies. And Brexit actually could be that next potential catalyst, as Kathy was saying, we'll have to see if that persistent appetite for risk assets continues. But that's something I'm going to be watching as well. I'll be listening to what they say about the direction of currencies. Other than that, we have earnings season is going to be is about to start, as you wanted me to talk about, Mike. Unofficially, we get to start off with Alcoa next week. It reports after the close, I believe, on Monday, and then we'll get the major U.S. banks following that. The expectations have been very low. We're looking for a 7.5% drop in profits, slightly better than last week. But if you compare it since the beginning of the year, analysts were expecting a 1.5% growth in earnings for the first quarter. Not surprising is that energy is going to be the biggest laggard. A bit more surprising is that if you X energy, we're still looking at an S&P 500 that's expected to decline about 3.3% year over year in terms of profits. Materials are also expected to fall hard, and industrials, because of uninspiring global economic growth, is also going to be a laggard. The one favored, actually a couple favored sectors is going to be consumer discretionary, and they're, obviously a net beneficiary of a resilient to strong job market here in the U.S., lower gas prices and interest rates, and that they're expected to increase their bottom line earnings by 11.5% year over year. And the other surprising sector, I would say, is telecoms, and that's something that we've recently added in the MUP portfolio. So going back to the earnings season, in terms of the impacts of currencies, I'll be watching what our currency experts say about this. The dollar has been, since the start of the year, a little bit weaker or more range-bound than we saw in the fourth quarter. So fourth quarter earnings, which was ended in December, CFOs of these large cap companies that do business abroad were a lot more conservative. Guidance was tighter. Expectations were not as rosy for the future. But when, since the start of the year, since the dollar has been heading, slightly south, we have a 5.5% drop in the dollar index. You may get a bit better guidance, a little bit more, constructive in terms of the future for S&P earnings expectations. We'll be looking for what that outlook is going to be looking like and see if that can help support the market a little bit. But on an absolute basis, I mean, there's no denying that, even if we beat those lower expectations, we've still got 4 quarters of consecutive declines. And if this market continues to kind of grind higher, then we're just getting pricier in terms of what we're paying for each dollar of a company's earnings, and therefore we could be, as Mike mentioned already, Wile E. Coyote coming off that cliff, and kind of when do you realize that there's nothing there to support you? And that's kind of analogous of what could be happening in terms of the earnings picture, especially if this market continues to grind higher. So that's my thoughts on earnings. I still agree with the other editors and the analysts on this call. The market still remains vulnerable. Interestingly, I'll include a little bit of a tidbit. The IMF released a report that warned of equity market correlations picking up between developed and developing countries. Yes, China's recent manufacturing numbers, were better, and thank our publisher Walter for getting us that report. That was back into expansion territory, which was positive. But the report showed that 80% of 2015 equity market moves were related to moves in outside markets, outside of a specific country, versus in 1995, those correlations were more like 50%. So we're kind of tied to what's happening in the rest of the world, and it bodes well to keep an eye closely on what's going on there. All in all, watch the dollar, watch company guidance, look for positive catalysts in this market. I'm saying I think that we're kind of running thin in terms of those. I would stay cautious. I'd like a pull back to about the 1950 level in the S&P, and that would be my next level to reassess adding to longs. And that's all I have, Mike.
All right, thanks, Mendy. Good points. We'll keep an eye on those earnings results. Let's see, David Dukevich, let's get your views on the markets here.
Hey, thanks, Mike. Hey, everyone. Well, last week I came out and said that, I think the one market you might want to be long was volatility. And the VIX managed to make a new low for the year after that.
Nice call.
Yeah, exactly. But I do think we're still trading. It dropped down to about 13 on the VIX cash, and we're back up to over 14. And it looks like today we're going to even see a bigger jump with the VIX futures up almost 5% this morning. So I do think after we did have a lull here for the last few weeks with volatility in the markets being in a trading range, as Larry mentioned earlier, and we've kind of touched new highs, but we really haven't surged and broken through, which does seem to lean towards we are going to have a pullback. The real question is how big of a pullback. If you look at the Fibonacci retracement levels, we're probably going to come back in between 1950 and 2000, somewhere in that range. So I would expect to see a move like that on the markets, which then we should see a move higher in volatility again. Again, it's volatility, the markets, everything's kind of been drifting sideways, where the markets have been drifting a little higher. Volatility is kind of drifted a little lower here, but we've seen that in all the markets right now. In fact, one of the better markets we've seen is over the last 30 days is actually natural gas, where actually the UNG, the natural gas ETF, has been the best performing U.S.-listed ETF over the last 30 days, up about 15%. So that's getting close. We might be able to see a bit of a breakout out of that range that it's been in for a while. Oil itself, ran up to just over $40, and it's pulled back in. If there's a bunch of support here at 36 level where it's trading right now, 35, 36, it could pull back even a little further and get maybe down to that $32, $33 range. But I do expect to see us, then bounce higher again and try to test a new breakout level again. Gold as well has really been in a range. It kind of couldn't get through that 1287.80 level. As it's tested, it's pulled back. Really hasn't completely broken down yet, so we're kind of still stuck in the middle part of that range. But I would expect to see us pull back a little bit further. I do think we'll see us crack that 1200 level and probably drop somewhere around 1180 to 1160 on that level. But right now, those are really the key levels. We need to see these markets kind of break where they are because they have been drifting in ranges lately. Once we get that move, then we'll probably know where we can start adding positions at this point.
Okay, sounds good. Thanks for the recap of all those markets. Well, that wraps things up for this week's Squawk Call. Great insights, ladies and gentlemen. Thank you, one and all, and be sure to tune in again next week. Until then, I'm Mike Bernick for Money and Markets. Good investing.